So we're looking at the Dawson Family Wealth Management case study on private wealth. Let's read this first question and then we'll dive into the reading. Question 1. Discuss 2 strategies the Dawsons could use to mitigate market volatility risk in their investment portfolio. Note, each strategy should be discussed in a separate paragraph. This seems like a pretty straightforward answer, but let's dive into the reading and make sure there's nothing here that we need to answer this. So the Dawson family, comprised of Robert Dawson, his wife Maria, and their son Lucas, have built significant wealth. Robert's successful career in technology combined with strategic investment decisions has allowed the family to accumulate substantial assets. Robert and Maria are now retired, and their primary focus is on preserving their wealth, ensuring it lasts through their retirement. So that kind of ties into why they may want to mitigate market volatility. They're looking to preserve their wealth, but also ensure it lasts through retirement, and planning for the financial well-being of future generations. Their investment portfolio, valued at $10 million, is allocated as follows: 60% stocks, 30% bonds, 10% real estate. In addition to this, they own a family business valued at $2 million and a vacation home worth $1 million. Okay, so I think we have enough information here to read this. There's some info here that's important to know, but we can kind of answer this as just kind of what are 2 ways that we can mitigate market volatility in an investment portfolio. So I'm going to pull in probably the 2 most straightforward answers. So one is just diversification. So holding assets that are not correlated with one another is going to help decrease market volatility. And then secondly, portfolio insurance. So this would be something like use of derivatives to hedge if selling assets is not ideal for tax or other reasons. So if we're holding, we may be holding some stocks at a really, really low cost basis, so we have a huge embedded gain. So rather than selling that and moving to cash, we could buy puts on that, for example, to kind of create that hedge or portfolio insurance without selling stock. So those are 2 reasons there. Question number 2, calculate the impact of a 3% annual inflation rate on the Dawsons' living expenses over 20 years. Explain how inflation could affect their overall wealth preservation strategy. So what we're going to do here is we're going to take the Dawsons' living expenses, and we're basically going to multiply that by 3% compound 3% inflation on those expenses for 20 years. And then that'll kind of tell us what their new living expenses are, and then we can talk about why that's important for their wealth. All right, so the Dawsons' annual living expenses are approximately $300K, with most expenses relating to maintaining their current lifestyle, travel, and healthcare. They are concerned about inflation eroding their purchasing power, potential market volatility affecting their investments, and ensuring their wealth lasts through their lives while being passed down tax efficiently to Lucas. So they kind of hit the nail on the head right there. So eroding their purchasing power, that's the concern with inflation. So let's pull in the answer here. So our new approximate expenses are going to be that $300K multiplied by 1.03 compounded for 20 years. So our new expenses is almost double, $541,000 and some change. And so that's going to be that'll be 1 point for you, and then the other 2 points is going to be on this explain. So how could this affect? If investments do not beat inflation, portfolio will not be able to continue supporting living expenses. And I probably could have written this, but therefore wealth will, they'll have to eat into the principal and not just be able to live off the kind of interesting gains there. Question number 3. Identify which of the above asset allocation strategies, A, B, C, or D, is most appropriate for the Dawson family. Justify your choice with 2 reasons. So it looks like we're going to be looking at these strategies. I think we only read 2 right here, though, so let's read the rest of this before we answer the question. So Lucas, a software engineer with a steady income, lacks investment experience, but is keen to learn more about managing the family wealth. The Dawsons have contacted you, their financial advisor, seeking comprehensive guidance on asset allocation, risk management, wealth preservation, and estate planning. The following table outlines 4 potential strategies. So we've got strategy A, B, C, or D. Which one is kind of most appropriate for them? So I am going to pull in the answer and then we'll talk through that. So just to kind of point out, it's usually good in these types of questions where there's multiple options to do the identify and then justify your choice with 2 reasons. And then it's usually good to kind of go through and say like why you didn't pick B, C, or D in this case. So we're going with option A. 2 reasons: most balanced approach, significant equities, so we've got 40% stocks, provide growth, and then we've got 40% bonds, which provide stability income for spending needs, and then the real estate and alternatives can provide some diversification. Cash at 5% allows sufficient liquidity if needed. And so just for kind of reference here, so they're at 5% liquidity at a portfolio of $10 million. They have living expenses are $300,000. So if they're at 5% cash, that means they're going to have $500,000 in cash. So we have over a whole year worth of annual living expenses kind of liquid for anything, that pops up just in case. So yeah, those are the 2 reasons there. And then for B, C, and D, let's kind of look at this and say why we didn't choose it. So B is likely too much stock allocation, exposing to too much market vol risk, which is something they mentioned earlier that they were kind of concerned about. So that references why I didn't pick that relative to the reading. C is too much cash. So we've got 25% cash. If we have $10 million and our spending is only $300K, there's no reason to be holding $2.5 million in cash. That's almost 8 years of living expenses sitting in cash, which is that's going to be a huge drag on our returns and not needed. And then D, not enough cash, so no liquidity in time of need. We're at 0% cash here, which we want to make sure we have some liquidity in the portfolio without it being too much of a drag like in strategy C. Question 4, describe an estate plan for the Dawsons. So this is a pretty open-ended question, so we'll just pull this in and then kind of talk through this. So a few ways to kind of reduce their taxable estate over time, which is typically the main purpose of estate planning. How can we pass this money along to Lucas in this instance tax efficiently? So one thing we can do: annual gifting to Lucas. Keeping gifts under the annual exemption helps us to not incur any gift taxes. And so typically how this works is Robert and his wife Maria would both be able to give Lucas, I think at this point in the US it's up to like $19,000 a year with inflation. So they could each give Lucas $19,000 a year. Then in 2026 maybe it's $20,000. And I'm just making that number up, but so they could give him $38,000 in this year, 2025, in theory, without incurring any gift taxes. Then next, if they're charitably inclined, then charitable giving via a charitable remainder trust or just giving during their lifetime. So the CRT charitable remainder trust, that's going to be basically they have control over the assets and can live off the income of the assets in the trust during their lifetimes. But then once they pass away, all the money in that trust then goes to the charity. And then third one, family limited partnership. So this would be gifting Lucas shares in the business over time. And then lastly, so these are mainly aimed at reducing the taxable estate. Then this last thing they could do to avoid probate, they could move assets into a revocable living trust, making things a little smoother to be passed along after to Lucas.